SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to the SUERF-Baffi Bocconi e-lecture on key results from the latest ECB Financial Stability Review, which was just released this morning. We are really very privileged to have two people with us today who are at the core of the ECB's FSR team. John Fell, Deputy Director General for Macroprudential Policies and Financial Stability Department, and Tamarah Shakir, Deputy Head of Division for Systemic Risk and Financial Institutions. John and Tamarah will start out presenting some key findings from the ECB FSR. To further add to the accumulation of expertise in this e-lecture, Olli Castrén, Head of Economic Analysis and Impact Assessment Division at the EBA, will discuss and comment John's and Tamarah's presentation. John and Tamarah, the floor is yours.
Thanks a lot, Ernest, and good afternoon, everyone. So on behalf of Tamarah and myself, let me again thank you, Ernest, and the SUERF board for inviting us back yet again to present the highlights of the November 2021 issue of the ECB's Financial Stability Review, which, as you mentioned, was published just this morning. So my hope is that the meaning of the graphic on this cover slide should become clearer as we go through the presentation. But to give a hint, in this issue, we try to look beyond the short term and towards the medium term in making our financial stability assessment. We do this because some trade-offs, especially policy trade-offs, but there are others, have led to a tilting of the time profile of financial stability risks as the economy and the financial system have adapted to the ongoing pandemic. As usual, with 5 chapters, 9 boxes, and 3 special features, my presentation will necessarily be selective, and I'm going to focus on the main messages. So let me turn to slide 2 and these exact same messages. So first and foremost, the FSR brings both good news and bad news for the financial stability assessment. Now, the good news is that pandemic-related risks appear to be receding, with corporates, sovereigns and banks all avoiding tail risk outcomes. The resilience of the financial system has been tested and its core parts have proven able to absorb the initial impact of the COVID-19 shock. However, the bad news is that apart from the demand side shock induced by the pandemic, protracted supply side disruptions and soaring energy prices are posing risks for both the inflation and the economic growth outlooks. Now, if this persists, it could yet prove particularly challenging for financial stability. At the same time, vulnerabilities are building up in property markets, and we continue to see signs of stretch in financial markets. And the non-banking sector, especially investment funds, appear to be disproportionately exposed to many of the attendant risks. So let's go to the next slide and how the good and the bad news translates into our financial stability assessment. Well, it does this, as I mentioned at the start, through a tilting of the time profile of sources of risks and vulnerabilities from the short to the medium term. Now you can see on the left that a range of short-term indicators of financial system stress have materially declined, some of them to 10-year lows. For instance, if you look there at the probability of simultaneous default of 2 or more large euro area banks over the next year, that's one of the indicators of financial system stress that we have. It's now less than 5%, and it hasn't been that low in the whole period shown on the chart. Now, this fading of near-term sources of systemic risk is undoubtedly due to the broadening of the economic recovery, especially as seen on the middle chart, and the recovery of value added in those countries and those economic sectors that were most affected by the pandemic. So we have sorted gross value added for the euro area, both across sectors and countries. And you can see that the blue line and the yellow line are beginning to converge back to where the less affected parts of the economies have been moving. But we also know that one of the legacies of the Great Lockdown has been an increase of private sector debt, as well as a surge of house prices. And these have driven an upturn of our medium-term systemic risk indicator. And you can see that there on the right with its decomposition. And so it is gradually moving up. Now, turning to slide 4, I already mentioned the risks posed by protracted supply-side disruptions and soaring energy prices. Now, the left chart here shows that services sectors are mostly affected by labour shortages, while manufacturing is mostly affected by shortages of materials. Now, this together with the broad-based increase of commodity prices, notwithstanding the more recent correction of the surge, but especially of natural gas, oil and coal, it could yet weigh on the economic recovery. And while it's clearly not the ECB's central scenario, if inflation were to rise by more than expected, and if growth expectations were disappointed simultaneously, that could pose new challenges for financial stability, especially if it were to widen the gap between interest rates and growth, and thereby threaten debt sustainability. Now, that said, and moving to slide 5, the next slide, we have not so far seen much evidence of debt sustainability challenges in the corporate sector. Second quarter profit figures for euro area firms were strong. In fact, they were just 2% off pre-pandemic levels, with 2/3 of Eurostoxx firms reporting earnings that beat analyst expectations. And realized default rates in the corporate sector have been coming down. As seen on the left, since the start of the pandemic, not only have realized defaults been consistently lower than Moody's baseline expectations, they have even come in lower than Moody's most optimistic scenario. So you've got the most optimistic, the most pessimistic, and the baseline all shown on that chart, and how defaults developed against those expectations. And you can see that they were consistently coming in better than expectations. Now, this is, of course, thanks to all of the support measures, which have arguably been more effective than might even have been initially expected. That said, some sectors were particularly hard hit, and they continue to struggle. The chart on the right has a somewhat Darwinian undertone to it, because it's showing bankruptcy declarations together with new business registrations, so kind of turnover in the sector, spurts and deaths, if you like. And it's clear that the accommodation and food services sectors have been scarred by the pandemic. They're down there in the shaded area on the southeast corner of the chart. Now, and looking ahead, we see a risk that corporate insolvencies could rise due to a backlog of unresolved bankruptcy cases and a gradual phasing out of policy support measures. But even so, we think that this would be far less than we had feared in, say, the early stages of the pandemic. Now, moving to slide 6 and sovereign debt markets, we have seen spreads for lower rated sovereigns fall over the last 18 months. And governments have taken advantage of this by issuing longer term debt at very low rates. Now, when we look at sovereign bank and sovereign corporate CDS spread pairings over time, we see them moving in a southwesterly direction. So basically spreads both for all sectors, sovereigns, banks and corporates, going down over the past year or so, as shown on the left. And that would suggest that the nexus between sovereigns, banks and corporates is currently more virtuous than vicious. Now, that said, the level of sovereign debt cannot be ignored, and this is where we start looking to the medium term, as I mentioned at the beginning. It's nearly 100% of euro area GDP on aggregate, and it's much higher for some countries. Now, the FSR includes a box that considers debt sustainability with scenarios for interest rates versus growth. And here, even using the baseline forecast, so that's the blue line, it will take a decade before debt ratios in higher debt countries are back to pre-pandemic levels. So this is just simulations for the higher debt euro area countries. And then you can see that a number of scenarios that are shown here suggest more challenging paths for debt to GDP. They are not the central scenario, they're adverse scenarios, but especially if the interest rate growth differential were to turn positive, then it couldn't be excluded that should any of those scenarios materialize, it could send the CDS pairings that I showed on the left in a more northeasterly direction back to where they came from. Now, going to the banks and slide 7, I already showed that systemic risk has faded, and an important reason for this is the containment of NPLs. At the same time, large waves of losses on corporate loans seem less likely to materialize than we had expected even 6 months ago. So banks were able to sell their NPLs through the pandemic, and thanks to this, NPL ratios have in fact fallen to 2.4% on aggregate. That is lower than before the sovereign debt crisis. And we expect that this trend is going to continue. We have looked at recent patterns of loan performance versus economic growth. And when we combine these with the ECB, with the most recent ECB staff projections, NPL ratios continue declining at a moderate pace, as you can see there on the left. Now, that said, the chart is also showing country sector ranges. And if you look at the top of the range, you can see that for some sectors in some countries, NPL ratios could still rise. But the key point and the key message coming from that chart is that we don't expect a broad-based rise of NPLs out to 2024. Now, as for bank profitability, trading income has improved, and while core interest income remains weak, it has stabilized. You can see it there on the middle, and that has helped lift the median euro area bank return on equity more or less to pre-pandemic levels. But in profitability terms, euro area banks remain at the bottom of the class in comparison to the advanced economy peers that are shown there on this chart, the US, the UK, Japan, and the Nordic countries. Now, turning to slide 8, after dropping by more than 40% in the early stages of the pandemic, euro area bank stock prices have recovered back to where they were early last year. And the same is true of price book ratios, as you can see there on the left. Now, apart from the improved economic growth outlook, we learned from market intelligence that the lifting of restrictions on dividends and the results of the EBA banking sector stress test in the summer led to expectations of a bumper year, not only for dividend payments, but also for equity buybacks, which would be quite a change compared to the experience that we've had over the last decades. Now, one indication that markets believe that banks will be returning equity to shareholders is the positive correlation that we've seen since June between individual bank share price changes and the level of bank capital ratios. It's shown there on the right. Now, shifting to commercial property on slide 9, the pandemic undoubtedly imposed considerable stress on this sector, especially in the retail segment, but also for office properties. While the proportion of respondents to a survey on commercial real estate sentiment that considers the market to be in a downturn has been shrinking, and you can see that there from the green area is getting smaller on that chart. The middle chart shows that retail and office segments have not yet reached their trough in terms of what's going to happen to rents. And the outlook for commercial property is not helped by structural factors such as the shift to shopping and working from home. Now, that said, it shouldn't be forgotten that the scenario for the EBA stress test contained very severe assumptions for commercial real estate, with prices dropping by almost 30% in that scenario. And the fact that banks proved overall resilience to that would suggest that the vulnerabilities lie elsewhere in the financial system. The right chart gives some figures for cumulative purchases of commercial real estate from 2015 to 2019, and it shows that half of the exposures have been accumulated outside the euro area. And of the half remaining, half of that is held by euro area investment funds. So they're exposed to about a quarter. Now, moving to slide 10 and residential real estate. Now, this is where we have probably made the biggest tonal shift in this issue of the FSR. In past issues, we have covered how demand for housing has been buoyant throughout the pandemic, thanks to protected employment and incomes, higher savings, and easy financing conditions. And the result has been that euro area house prices rose by 7.3% in the second quarter of this year, are the fastest pace of growth that we have seen since 2005. Now, while mortgage growth has not yet reached the levels that we saw before the global financial crisis, it did grow by over 5% in the second quarter, and in some countries, the figures are much larger than that. Now, we have a box in the FSR that compares recent developments with the last big housing boom and bust a decade ago, and it concludes that we aren't at the extremes that we saw then yet, but there are some features which lead us to the conclusion that we're getting close. And one area where we're trying to get clarity on is on trends in lending standards. Data gaps here are large, but using data on securitized loans corroborated by past surveys, we see a notable increase in high loan-to-income and high loan-to-value mortgages. And you can see that there on the middle chart. Now, on the loan-to-income side, there is, of course, some mitigation of the direct risk to households because actual debt servicing costs are very low. And you can see that there on the right. But we also know that signs of easing credit standards have often been a harbinger of exuberance. And so this will warrant close monitoring going forward. Expect future issues of the FSR to be looking at this issue more closely. Now, turning to slide 11 and financial markets, as Euro area economic surprises, data surprises, that is, turned negative in the summer, so the data was coming out worse than markets had expected. Real long-term bond yields fell to all-time lows while inflation expectations rose. Now, this pattern, which seems largely symptomatic of a supply-side shock to the economy, is actually common to many advanced economies, and it doesn't seem to have halted the search for yield that we have been warning about in the past several issues of the FSR. If anything, exuberance has continued with return deviations from long-term averages for a basket of global financial assets reaching almost 2 standard deviations, as you can see there on the middle chart, and the highest level certainly that we have seen in all the periods since the global financial crisis. Search for yield has led to very tight spreads in the corporate bond markets and very high price earnings ratios in equity markets, and this is also true in the euro area. Alternative assets such as Bitcoin and various types of stablecoin have been beneficiaries as well. As you can see on the right, since the start of the pandemic, the market capitalization of the largest stablecoins has followed an exponential curve from just a few billions at the start of the pandemic, literally, to almost 120 billion in a matter of just 20 months. Now, we've dedicated a box in the FSR to the risks posed both to speculative holders and to the wider market from the growing large pools of assets that stablecoins use to back their tokens. Now, moving to slide 12 and non-banks, this is the sector that is most exposed to the exuberance in financial markets. As I said at the beginning, we have been concerned for some time about the growing exposure of the investment fund sector to credit, duration, and liquidity risk. Now, the left chart shows these vulnerabilities. It's showing all 3 dimensions on the one chart. It's showing that all of those vulnerabilities have continued rising and are even larger now than they were before the pandemic, which, as you know, was a moment when vulnerabilities in the sector were unearthed. Now, holdings of BBB and sub-investment grade bonds now represent more than 54% of investment fund portfolios. So that means that the sector has become an important source of real economy finance. But notwithstanding that, low liquidity buffers mean that source of finance could yet prove very fragile if the sector were subject to unexpected disturbances. Also, as shown on the right, reflecting the buildup of duration risk, we also see increasing sensitivity of investment fund portfolios to interest rate rises. Now, while this is also true for insurance and pension funds, those funds are usually hedged on the liability side. Investment funds are not. And so interest rate shocks would in the overall balance sheet impact would be much larger for the sector. So that's it for the risk and vulnerability outlook. Let me hand over here to Tamarah, who's going to cover the main policy messages that we've highlighted in this issue, and perhaps she might also give a more detailed explanation of the graphic that I showed at the start.
Thank you, John, and thank you for having me here this afternoon as well, Ernest. So yes, indeed, in terms of the policy messages, so these really stem from the risk assessment that John's walked you through. So we're talking here about financial and prudential policy measures, and as the focus in terms of risks is moving from the near term into the medium term, so is our policy message. there. So if you recall, over the last year and a half, we've seen an extraordinary amount of policy support, and as we've talked about before, this has really underpinned a lot of aspects of the economy, and is part of the reason that we think we've seen this relatively low spillover into corporate insolvency, and then in turn into the effect on banks. And indeed, we have been arguing in recent issues that these policies can become more targeted over time, and the fiscal measures have been becoming more targeted over time. We've seen that in a number of countries. On top of that, in recent months, we've seen moratoria on bank loans expire. John gave you a little bit of a flavour of how that sort of hasn't necessarily materialised in higher NPLs. And also loan guarantee usage has fallen back. We still think that support has a role to play, and it shouldn't be removed in a hasty way. That would be pulling the rug from under the carpet of the recovery. At the same time, we think more focus needs to be given to gradually addressing the medium-term vulnerabilities, in particular real estate measures, and then the general resilience of the system. And alongside that, we do see a case for ongoing work to strengthen the regulatory framework for structural challenges and for new challenges that are emerging. So to give you just a little bit of flavour on that, John talked a bit about residential real estate. That is one area where we think there are a number of countries that should be doing more to consider what they can do to manage vulnerabilities arising from this sector. The ESRB had made a series of recommendations last year to countries already, and in some cases not much action has necessarily been seen, and we think that those messages may be can be reiterated and should be taken heed of, and countries sort of need to decide what policies they can implement or are available to them. In parallel to that, the other area John talked about in terms of the risks has been those coming from financial markets and non-banks. This has obviously been an ongoing area of discussion for us in the FSR. Particularly, one area was that in March 2020, we saw the turmoil on markets highlight the need to strengthen the general framework for non-banks, but specifically with the issues arising for the money market funds with the flight for cash that they saw. And that's an area where we have seen material progress, and we would support continuing measures. Specifically, the FSB, the Financial Stability Board, recently issued a set of policy proposals that would tackle vulnerabilities in money market funds internationally. And they aim to do that by increasing the resilience of money market funds and reducing the liquidity mismatches within them. And in the FSR, and the analysis that you can see here, we put out analysis where we think there is support for looking at public debt requirements for money market funds, and how these could be used to help manage another period of high outflows, and diversify their sources of liquidity so they could help them sort of meet large and unexpected outflows. The calibration of those requirements, we think, needs to take into account costs and constraints, of course, and that is an area of ongoing debate. But we talk here about how a range of increase in minimum public debt requirements from 5 to 15% could, 5 to 20% could affect the number of money market funds that were able to meet outflows should the events of March 2020 be repeated. So that's one area where we're seeing more specificity arise, and in terms of policy, and would be a structural improvement in a big gap in the macroprudential framework. Beyond ROE and money market funds, we also highlight quite a range of other policy measures that we support in this financial stability review, including structural issues. And a few that were worth mentioning here, I think, today, not new topics, but they bear repeating, are the full and timely implementation of Basel III. And you know that there is a live debate at the moment about how that will happen in the euro area. We're quite strong advocates of full implementation of that. The completion of the banking union continues to be one of those issues that when we look at a range of risks, particularly some of the structural issues around bank profitability, completion of the banking union could provide material help and support. And indeed, there's also an allusion to a special feature in this FSR which discusses bank cross-border mergers and acquisitions and the role that they could play in enhancing euro area bank profitability. And then finally, this FSR didn't contain a lot of new analysis on the climate transition, but it remains a front and centre topic for us in the financial stability arena. And the analysis that have been published in recent FSRs has continued to be developed, with the main message being the benefits of supporting an orderly climate transition clearly outweigh the costs of moving to chaotic climate change. And with that, I think we can wrap up. As John said, we're always trying to find new ways of communicating the main messages of the Financial Stability Review, and this is produced by a close colleague of John's, who works in John's office, Inka Cordero Garcia, and she has read the FSR, and this is how she envisaged the main messages. So I think she's captured nearly everything we've got here, from the reopening of the economy that we've seen over summer and people being able to take holidays, through to the challenges we're seeing now with people fighting over supply chain shortages and making sure they can get their goods, rising energy prices, lower vaccination rates in emerging economies, which actually, we do think could mean pose risks to the global recovery. And then looking further ahead, the range of medium-term vulnerabilities highlighted here, from debt to exuberance of financial markets, expansion in housing prices and rising prices, and our struggling plan. Thank you.
Thank you, Tamarah. I try to interpret this picture, and I take it as a sign of complexity and of the multiplicity of shocks that are hitting at us, not as a sign of chaos. And the help sign I take as a sign of help coming from the policymakers and from the governments, and not as a cry for help from the private sector or from economic agents. Thank you very much for this excellent overview. I myself had a detailed read, actually, of the FSR over the past couple of days. And you, of course, had to be selective, and I can encourage our audience to really have a closer look. There is even much more interesting material in the report. So thanks for the summary. I now hand over to Olli Castrén from the EBA, who will provide some, I'm sure, critical comments. Olli, the floor is yours.
Thank you very much, Ernst. And let me just try to share these slides. I hope they are going to be visible for you.
We can see it. Just make it full screen view and we're fine.
Yeah, is that okay now?
Perfect.
Very
Excellent.
good.
Thank you.
So yeah, so indeed, as Ernst was saying, so it's clear that John and Tamarah necessarily had to make just a summary of the vast amount of material in the FSR. What I'm going to do here is just essentially a summary of summary, so I need to be even more selective. But hopefully I managed to capture some of the key points here. So just going to main discussion first. So the main risks and vulnerabilities identified in the ECB FSR, and this is essentially from the point of view of somebody who read it, and also before having looked at the press comments that are quite ample actually this morning after the publication of the report itself. But these are the kind of key points that came up after my reading of the report. So corporate insolvencies obviously have been less severe, but supply chain bottlenecks have been more severe than anticipated. So essentially the implication of that is that the kind of feared scarce potential growth have probably been less so than expected, at least so far, whereas the inflation has been surprising to the upside. And it is a bit of a mystery, of course, apart from all the policy action that's been putting into place to protect the corporate sector, how the insolvencies have actually been so low. And actually we had a presentation yesterday here at the EBA by the chief economist of BIS, Hyun Shin, who calls this mystery of a bankruptcy gap. So essentially, normally you would expect the fall in GDP and rising unemployment rates to be good predictors of higher insolvencies, but clearly hasn't happened this time. So there's a kind of big gap in that time series, and I found that analysis very interesting. Residential real estate prices obviously and their affordability are becoming a serious issue, and we all know from past crises what that can imply in the medium term. High debt levels, both in public and private sectors, seem to be sustainable for the time being, but very much still conditional on the growth interest rate gap remaining positive, which going forward could become challenged at least from time to time. Surge in valuation of risk assets did anticipate the post-COVID recovery in earnings. That I think comes quite clearly out from many of the charts that are presented in this report. But the falling real yields more recently could now be incentivizing risk-taking beyond fundamentals. And I did like a lot the focus on real yields on this presentation, because I think it's something that has not received appropriate attention, because with the increasing inflation now globally, I think the real yields are really becoming an important factor in driving risk-taking. Finally, there's an interesting special feature article about banks' willingness to use regulatory capital buffers. Not perhaps surprisingly, it's found that it's limited, and banks with particularly lower managerial buffers tend to reduce lending and consequently lose market share in downturns. But I think it was extremely nice to see robust empirical evidence of showing that this actually can be the case in the EU banking markets. Moving to the next slide, so some interesting details identified in ECB Financial Stability Report this time. So many regulatory support measures have expired without much impact, and that's obviously hugely positive development. And mostly the FSR is focusing on the low moratoria that have been placed in different countries, and where also we in the EBA played a role in providing some harmonized guidelines for that. In addition, however, there are some government support schemes that continue in some countries in particular, and they show some deterioration in credit quality. So this is something possibly worth keeping an eye on in the future. The report, as John and Tamarah showed, recommends targeted measures to address the residential real estate vulnerabilities. In particular in the form of macroprudential measures in individual countries. That's very important and timely, I think. It's also worth mentioning that there is now some interplay with this in the implementation in the EU of the new Basel III rules that could be taken into account, because the new Basel III rules are actually bringing into already the prudential framework, in the Pillar 1 framework, if you want, some of those risks that previously had to be addressed by the supplementary buffers plus macroprudential policies. So there's an interesting interplay there that is worth taking into account. Next point, duration risk is an important vulnerability for non-banks. I think that's a really good observation, in particular in a high leverage environment. So not only the level of the interest rate, but also volatility could be a trigger for corrections in that area. I like there was a short but quite interesting discussion about stock bond correlations. This was something that the market participants were discussing quite a lot in the middle of this year. It's a factor complicating portfolio diversification and risk management, and definitely I think is something worth following going forward. And then finally, the box on stable coins that John and Tamarah also highlighted in the presentation, I think is very important. very useful reading, I think, for everybody. So stablecoins tend to be functioning a little bit like money market funds, but they do also have similarities to ETFs with sponsors and onboarding and offboarding. So they have similarities to many different types of instruments that we actually observe in the financial markets. And in that context, I think it's important to mention at this stage that regulatory treatment of crypto assets in the EU is forthcoming. So the markets in crypto assets is advancing in the European Council actually, and the next step will be the discussion in European Parliament early next year. So EU is actually moving ahead here, ahead of many other major markets in the developed world. Some additional issues that may warrant attention, and this is my last slide. I think the report correctly identifies plenty of vulnerabilities, but it's occasionally a bit less clear about potential triggers. So there could be faster than expected or faster than intended moves higher in interest rates. That was actually mentioned by John in the presentation. One could imagine medium-term policy action to affect housing affordability, actions related to enforcing climate transition. All these things, I think, are kind of medium-term potential triggers that need to be watched very closely in the future. There are some cross-border differences in COVID recovery processes, and also as a result in the inflation risks featured in different countries. US, UK, Central Eastern Europe seem to be moving faster in policy normalization than EU, and this may create some financial spillover effects to those areas which don't foresee the inflation risks as forthcoming as these countries. Transition risks related to environmental and so ESG risks more generally, they warrant careful monitoring in my view, because investment patterns are shifting very quickly. So the recovery from COVID has already highlighted the potential supply side distortions in the case of sudden shifts in consumption of physical investments or financing patterns. So I think it provides some good material to project further out in what might be coming when the transition to the zero carbon economy is kicking in earnest. Operational risks are on the rise. This is something that we are watching very closely in EBA, and we are continuing to put more resources on this, because EU banks continue to report both more loss events and higher losses related to cyber risks. So ransomware attacks, supply chain attacks are increasing in frequency and sophistication. So operational risk is definitely something that is increasing in our own risk assessment in importance. And finally, Tamarah was mentioning about the analysis done in the FSR about money market funds and money market reform. So maybe just in the context of that, also to highlight here that the framework for the new EU regulation on investment firms also entered into the force in June this year. This includes capital reporting and disclosure requirements for investment firms that are stricter for large global players, and they will be phased in stages over the coming years. So far, large investment firms in Europe have been essentially regulated according to the bank regulations, CRR, CRD framework, but now the IFD, IFR framework will take over from that. So I will stop there, and thanks very much for the opportunity to read the report and discuss it.
Thank you very much, Olli. I would suggest that at this point we give John and Tamarah an opportunity to react to Olli's comments.
Thanks a lot to Olli. I think you did a remarkable job with the short time that you had to look at it to extract those messages. And I mean, I think you really have. I mean, I think we're both very pleased that you really honed in on the on the messages that we really wanted to underscore in the FSR. And of course, I mean, your comments are also very thoughtful. Just in terms of your last slide, I mean, I was comforted when I saw it that you didn't appear to have issues with our assessment of the banking sector more generally, except on the operational risks and the ransomware issues and so on, and those points that you quite rightly mentioned. On the latter, I think measurement is an issue. And I think it would be actually very useful to exchange notes, because this point has been made and is increasingly made to us, and all that we could do to measure this risk going forward would be very good. I think we would agree with pretty much everything that you have on your slide on the additional issues that may warrant attention. On this point of vulnerabilities and triggers, well, I mean, I think, Olli, you well know, because you used to be part of the FSR team a long time ago, and we took a conscious decision to focus more on the vulnerabilities than on the triggers. And the reason for that, of course, for colleagues who have joined the call, is that vulnerabilities are easier to spot. The triggers, I mean, because they are shocks, they're by definition impossible to predict. They're unexpected events, and so I mean, to give an example, I mean, if you read Robert Schiller's Irrational Exuberance, everybody knew that the stock market was, well, looking backwards, everybody knew that the stock market was overvalued in 1929. All the vulnerability indicators were there, but the triggers, what actually caused it, people are still studying that. They don't have an answer for what was the actual cause of it. So, I mean, it could be many different scenarios. Just the ones that you mentioned, and I think also, I mean, maybe this time as well, I mean, with this outlook of, I mean, vulnerability to shocks on interest rates or inflation expectations and so on. Obviously, that they are in the focus at the moment, and not only because they could affect any one of the vulnerabilities, but in fact they could affect almost all of them. And so I think it's still not bad to have some of these out of the box discussions about what could possibly go wrong. But that's the reason for the vulnerabilities emphasis, is that because that really tells you if there were fault lines or not, and those fault lines could be exposed by any one of a number of different triggers. Cross-border points, I thought maybe it's too subliminal, but I thought that we did have that kind of in there. I mean, I fully agree with what you said, that the euro area capital markets in particular could be vulnerable to spillovers coming from the rest of the world. The euro area, the beta of euro area assets is not one, of course, and global shifts in capital markets, could indeed lead to an unwarranted, let's say, tightening of financing conditions that could be unhelpful for financial stability. I think you make a good point on the lessons from the adjustment of the supply side to the fragilities, and I guess you're talking about the fragilities that we're learning about the the just-in-time production and inventory setups that we had globally, just how fragile they are. I think that this is probably going to be one of the big lessons out of the whole COVID thing, is the fragilities on the supply side of the economy, and I think many of us are still learning here. But I think you're quite right that should also help in our thinking towards the transition risks to do with climate. Very good.
Tamarah, do you want to add anything?
No, I think John covered all the points. Olli, goodness, thank few ideas, and indeed it would be useful to share notes on the cyber and operational risk points. We struggle with that.
Okay. I have Karl Christoph Hedrich who wants to ask a question. Christoph, we just gave you the microphone.
Thank you. Good afternoon to all. Can you hear me?
Yes.
Yes, we can.
Yeah, okay. Yeah, this is extremely interesting, and of course, it needs more time to read the report in full. So thank you very much for your presentations. If I am well informed, Vice President de Guindos today has been asked about non-banks and their importance, and we know that bank deposits are not so attractive anymore for savers, and so non-banks and funds are playing a major role. But he did not exclude, in the case of massive outflows, access to ECB liquidity for non-banks. I think that would be new in our financial system. How do you assess the importance of non-banks and their systemic importance? And is it already a situation where the wall between banks and non-banks can be broken down?
Should we answer now, or
Yes, yes, go ahead, John.
Yeah, so I was there at the press conference this morning, Kurt Christoph. I mean, I think on the question of non-banks and their liquidity, I mean, I think the Vice President was very much emphasizing that we need to find that the macroprudential policies were the first line of defense to avoid that we would have a repeat of the kind of liquidity problems that we saw last March. And that this would, you know, this would require better liquidity management by the investment fund sector itself. I mean, I don't think that he said that we would be advocating that non-banks would have access to the ECB. He certainly didn't say that in the press conference this morning. Yeah, so that has been our stance, and that's been our stance on that point actually for quite some time, predating the turmoil that we saw last March. I mean, if the sector were able to internalize and manage its own liquidity risks better, we wouldn't be having these kinds of discussions about the need and reliance on, you know, the possible reliance on central bank liquidity, which of course, I mean, even if that did exist, it would have both pros and cons. The main cons being, of course, all of the moral hazards and you know, the impact that would have on the other side of the risk management of investment banks if they felt that they didn't have to worry about their liquidity, or that if there were drains on investment funds, and if there were drains on their liquidity redemption requests and so on, that they could be just go to the central bank and get the money. So I mean, it's a complicated issue, and I mean, I think we're really trying to promote solutions that would avoid these kinds of moral hazards.
Thank you, John. I think we want to use the time that Olli is still with us. So I would like to ask maybe a broader question, which all of you might try to answer, which is the question: if you look at asset valuations right now, and also if you look at loans in banks, in bank books, is there an underpricing of risk at the current situation due to a general risk-on attitude in financial markets and among economic agents more generally, and due to the low risk-free rates? So does an underpricing of risk, is this at the source of current bubbles in various asset classes, and does this pose also a risk eventually for banks' loan books?
Who wants to go? You looked like you were going to go, Olli.
Well, no, just to say something, we actually do have our own risk assessment report, which is going to be published in a couple of weeks' time, where some of these issues will be looked more in detail. But I would say, look, I mean, by looking at, for example, the ECB bank lending survey, I don't think that we can see any dramatic increase in the bank's kind of positive attitude towards risk. I think there is still, especially in the corporate lending side, there is still a kind of healthy amount of risk aversion. I mean, banks there. When it comes to real estate lending, residential real estate lending in particular, what John was, I think, correctly highlighting as a kind of key medium-term risk. I think, you know, look, in EU, I think you can detect some areas and some pockets of vulnerability where you can potentially say that markets have gone ahead of themselves, and for this reason, I think it's very important that those policy measures that John and Tamarah were proposing would be seriously considered. Just let me take this opportunity to say something about the previous question as well, because I think it was important that the new investment firm regulation that I mentioned will actually take into account some of these issues. So there will be capital requirements, liquidity requirements for larger firms coming in the future. So from you know, partially these issues in the future will probably be addressed by more specific regulation going forward.
On the asset prices, I could compliment perhaps Ernest. I mean, I think you already hinted at some of the factors. I mean, one of the indicators that we look at is the cyclically adjusted price earnings ratio. This is I mentioned Robert Shiller at the beginning. This is his indicator of long-term valuation. And if you look at, you know, the longest time series available is available for the US, and the historical average of that measure of the price earnings ratio for the US is about 15, going back to 1870. Currently, it's above 40. And so that gives a kind of an indication of, you know, at least it might, you know, give a kind of a sniff, a smell that something might be wrong. Now, but Robert Shiller himself has, I think, recognized that we're not getting the mean reversion back to that 15 anymore, and we're not getting it because interest rates are much lower than they have ever been before. And so, I mean, he's adapted his valuation metric with the so-called excess CAPE yield. So this is measuring the inverse of that minus the bond yield. And in fact, and that gives you a kind of a rough indication of whether or not you have an equity risk premium or not. It went negative before the dot-com bubble burst in 2000. It hasn't gone negative, actually, yet. And I think exuberance looks highest in the US, but still, I mean, I think that kind of level of valuation, I mean, it implies you invert it, so it's you get a measure of the real earnings yield expectation. It would mean that, you know, investors getting into equity markets today should expect a return of about 2.5% over the next 10 years, compared to 6.5% on average when it was 15, roughly. So that's what it means. These excessive valuations just mean that investors getting into assets now can either expect very low returns in the future or capital losses in the near term. We don't see those metrics at as high a level in Europe, but I mean the correlations, of course, have been high, and asset markets have been exuberant also in the euro area this year. 20% increases and more in equity prices, and spreads very narrow as well in corporate bond markets.
Thank you, John. I now turn to a couple of questions that have come up, and maybe you want to go into one or the other if you find it fits. So one question was about the impact of a more severe than expected COVID wave number 4/5, depending on the respective country. I don't know what you know, what closing date you had for drafting the FSR. But it seems to me that the past 2 weeks or 3 weeks have brought a lot of development in the COVID sphere that you may possibly not have anticipated in the report. So what might it imply for your assessment of bankruptcies, loan, and therefore, and also therefore government debt because of renewed need for rescue packages? Then another question, I think I give you a few questions which I found, and then you answer in the way you find suitable. Another question is, you mention in the report that the longer duration and the fixed interest rate nature of sovereign bond issuance, that implies that despite the higher debt levels, there is not extremely high risk from the sovereign indebtedness. But at the same time, this long-term fixation of very, very low interest rates implies that the risk, the interest rate risk, is shifted to institutional investors and also, of course, to households like retired people who save for their pensions. So the risk doesn't go away, it just shifted within the system. And my question is to what extent you have taken this into account. And of course, a similar argument applies to real estate markets. I don't know about other countries, but in Austria, we're quite proud that a rising share of real estate loans is now fixed interest. That means that households become less vulnerable. But at the same time, what does it then imply for the lender, for the bank? If households have 20, 25 years of very, very cheap 1.3% real estate loans. Then on the climate transition, which I found very interesting and relevant that you address it in the report, I think there's a little bit of a discussion in the public and in the media right now about a green asset bubble. So do you see the risk of a green asset bubble, which comes from the simple fact that there is lots of investors now want to act in a good way, but there is not enough material in the market? And similar to this, also linked to this, the question, what if there were a sudden stop in investors' readiness to buy brown assets? So these brown assets could then suddenly collapse in price, and the financing of these brown companies might really get into trouble. Some people argue that this might be at the root of the supply bottlenecks in energy and so on, because companies find it difficult to finance exploration and so on. The insolvency backlog has been mentioned by Olli. He quoted Sheen with the mystery of bankruptcy gap. I would rather call it a backlog. So how big do you see this backlog? You addressed it in one of the charts. I found this personally very relevant. Then a question linked to interest rate change is a question on the resilience of insurers. Now, I'm aware the ECB is not the supervisor of insurers, but from a broader financial stability perspective, it is of course an interesting segment. And if you combine this with climate risks that come towards insurers, I think you pointed it out in one of the slides, then how severe do you see the risk for these financial intermediaries? And finally, if there is time left, I found quite interesting your special feature on bank M&A activity. So if we still have time, maybe you could sketch for the participants a few ideas or a few findings from this special feature. Thank you very much, and sorry for the wave of questions.
How do you want to do it, Tamarah? Do you want to have a first go?
Okay. Until I just threw me out there. I'll do a couple, but John, I think
Yeah,
you'll
sure. No,
definitely
no.
have,
I've taken good
have
note.
views.
I've taken good note.
So on the increase in infections, first of all, across the euro area, indeed, this has been an evolving story as we've been writing the FSR. What I will say, what we're mindful of is it does still seem to be the case that any lockdowns that are likely to come this winter in the euro area will look different to the level of lockdowns we saw a year ago. So particularly, for example, this distinction between the vaccinated and the unvaccinated population, and the nature of the restrictions. So that's part one. Part two, the other thing we have also observed is, and it's actually within the last FSR, over time the economy does seem to have been a bit more resilient to each successive round of lockdown. So there's been some element of adaptation from some sectors, so they found ways to operate. Nonetheless, of course, a kind of widespread or generalized lockdown would be a new set of challenges. And I think you make the point that we would probably have to consider around policy space to provide the level of support, probably particularly, would fiscal policy at some point be tested? Although every time we think that might be the case, we get proved wrong and space appears there. But John might have what to say about on that. And then in your relation on the transfer of risks, indeed, I think this is an interesting observation and one we allude to on the mortgage side. So we do talk about the fact that the fixed rate mortgages have meant that the risk of interest rates is likely to be banks. A question then that we need to think about harder is how exposed are banks in two dimensions. Their active hedging, that's probably limited. Olli might have views on that. I think it's had to drop a bit on that. But also there are kind of organic or the natural hedging that exists in banks. I mean, John talked a bit about the role of natural hedging and insurers and pension funds, and there's always that question with banks, to what extent do you think customer funding is a sort of natural hedge on rate risk? But certainly the question of who's bearing that risk on the housing side is one that's live, and the similar point, I mean, we showed it really, that it's shown the extension of duration in sovereigns is helping sovereigns, and it's moved to the non-bank sector, and we showed you kind of both charts, as it were, in the presentation. Sovereigns are probably more problematic, so I think historically the challenge you get is concentration in a sovereign. So I think there's maybe a debate to be had about what's better for the financial system as a whole, dispersion or concentration. But I don't think that's the question we answer, so that would be a personal view. I could stop it. I mean, on the climate transition, I don't know if a bubble feels too far for what we've seen. Certainly what I've seen in terms of this so-called green premium or the greenium has been a bit mixed. Although admittedly I haven't looked at that very recently. I think our bigger concern is this greenwashing problem. So this idea of it, so to the extent it's a bubble of things that are falsely labelled as green and then will be later categorised as not so green. And I think that's the one that we've highlighted as being a first order concern, and where disclosure and standards need to move to catch up with the clear demand in the world for more green investment and investment to support the transition. There, and I can come back to that. On the insolvency backlog or gap, so we do think that there's a case, as John showed. I mean, John, maybe you will say this one, but that over the next couple of years, it could take a while for this to work out. So we had in the NPL chart about 2 years, and could be the lag time to see NPLs from the COVID shock to materialise for some sectors. I don't know if your question, I may have misunderstood it, is also this slight mystery of where are the missing insolvencies that you might have expected to see. Have we completely avoided them, or are they going to show up at some later day, or are they going to be a result in zombification, or what's going to be the outcome? John, I don't think we've got an answer to that. I think it's a hanging question, but maybe you've thought about it more than me. And maybe I'll leave the interest rate question to John.
But you covered basically more or less everything. I mean, I think what you said, the way you characterized it, Ernest, about transfer of risk. I think we don't say that directly, but I think it's a good way of characterizing some of the messages that we have. So that's for sure. I mean, what you said about the price of sovereign debt sustainability is this transfer of risk to the holders of the paper, and this is why. I mean, in the graphic that we had, you don't see sovereign risk in the near term, but you see it in the more distant future. And so, I mean, that's how we're characterizing the risks for sovereigns at the moment, and you see it in the pricing. I mean, you don't see much sensitivity of CDS spread. You saw the chart with sovereign spreads down in the southwest corner of that chart that I had. I mean, and I think what you said about the banks is also true. I mean, it doesn't augur well for, let's say, medium term profitability outlook for the banking sector. So I mean, we're seeing NIMs, net interest margins, improving because of stronger growth in volumes than in the pricing, and so banks lending into the mortgage market, high growth rates in the mortgage market, lending at low rates and fixed rates. So they're not going to have the pricing power going forward. And as Tamarah said, that there may be issues around the hedging of that, that we need to understand better. You know, whether the risk, we know that there's been a transfer of risk. Has it been from the households to the banks, but did the banks manage to transfer it again somewhere else? This is something that I think is going to become a more and more important issue going forward, and we're worried about it from a banking sector profitability perspective. What else? On the special feature, you said you were interested in the special feature, Ernest. So I'm glad you've paid attention that you paid attention to that. I mean, I think that this is a very interesting piece of analysis where the colleagues that worked on this looked at M&A activity in the euro area, separating between domestic and cross-border, and looking to see over time which type of M&A activity was having the biggest impact on profitability. And I mean, what they found was that the cross-border mergers had actually been more profitable than the domestic ones, but that was before the global financial crisis, and that since there has been a kind of a step shift since there. Of course, I think that there has been, I mean, one of the symptoms, I mean, one of the developments that we saw in the global financial crisis was, of course, some banks had paid way too much for the banks that they had acquired, and that those were chickens that came home to roost during the crisis. And so the next generation of CEOs, I think, were reluctant to get into the cross-border activity after that, because, you know, if there was one thing that is guaranteed to shorten the term expectancy of a CEO is making a bad decision on an M&A. Yeah, I mean, I think it discusses the economics and, you know, and the different nature and the different objectives of domestic versus cross-border. I mean, the domestic are, I mean, it's more about cost saving, whereas the cross-border is more about diversification. And of course, the big hope for the banking union is that we have a more diversified banking system over time, of course, with a lower cost base, ideally, as well. So, I mean, I think that there's some empirical evidence that shows that is possible. And yeah, I mean, we have to really get to grips and understand, you know, all of the different impediments to M&A in the banking industry in Europe, because I think if there's one theme that probably has been continuous from one issue of the FSR to the other, has been this one of the structural issues in the European banking sector, and the inefficiencies and overbanking even in some parts of the banking system, that you know, we're not going to deal with a profitability problem if we don't deal with that first.
Yeah, thank you
Is
very
that
much.
it? Does that cover everything?
Yes, this covers everything. I was so interested in this question because at a conference, say 2-3 years ago, I think one of the conclusions back then was that actually there is pretty little mergers and acquisitions going on among banks in Europe. And you know, we always emphasize that profitability needs to improve. So why is not more cross-border M&A happening? And one of the reasons given there was that actually, given due to language, legal differences, mentality, customer behavior differences, and so on, actually there is not sufficient economies of scale to get from such mergers, and therefore it's not done. And it seems to me that your special feature shows also that it more happens among clusters of countries that maybe are more similar in terms of these features that I just mentioned. And this might be one of the driving forces, but also one of the limits to this development. So I think this is an interesting topic also for the future. And we have Carl Christoph Hedrich from Commerzbank sitting here, who 2 years ago or 3 years ago was in the middle of the storm of a possible merger, which then in the end didn't materialize. So I don't know whether Carl Christoph dares or wishes to comment on this.
Commerzbank is a target for merger since 30 years. I am with Commerzbank since 28, and so I can confirm that we have some experience with rumors and one real merger. Yes, it's Dresdner Bank, where Dresdner Bank has been. Okay,
yes, exactly.
I know this discussion, and I've seen this special feature in the report, and I have printed it out already. It's really interesting because it's not only the new literature you are quoting, but also the old. I already know that I think not much has changed. But if I may add a question, if you allow, in this context, because we are reflecting about on this since very long time. If we would have more cross-border mergers, what would happen? I would imagine that bank deposits from surplus countries would be transferred to deficit countries, let's say. I do not want to mention Germany and Italy, but let's say other countries. No more via markets, capital markets and bonds and so on, but via the internal treasury department of the merged bank. But what does it mean for financial stability? And we have seen that these direct banks, as ING has been active in Germany, transferring deposits to the Netherlands with a stronger loan market and demand. What does that mean? If a treasury of Santander in Madrid is deciding upon allocation of savings and not the market?
Well,
it's a more theoretical question, I know, but we have academics here, so.
I think it's a very practical question, and I pretty much recall very similar considerations during the global financial crisis. You know, big Italian bank owning the biggest Austrian bank, many Austrian banks owning many Eastern European banks, that the question of ring fencing was very topical back then. So I think it is a relevant question. Fortunately, right now it is not at the core, it seems to me. But maybe John or Tamarah want to briefly comment on this before we close.
I mean, maybe, but just a bit related. It's related, but it's not directly answering Carl Christoph's question, which I found very, very thoughtful. But I've just been reminded of a paper that I read many years ago by Lorenzo Bini-Smaghi, who you will know very well, Ernest. And this was looking at the euro area as an optimal currency area. And in the analysis, he made a comparison between the euro area, the potential euro area at the time, because I think it was written even before monetary unification. He makes the point in that paper, if I remember it well, that the euro area as an economy, when you look at individual countries of the euro area, and you're trying to explain why you got more cross-border M&A in the US, let's say, or you've got more US active banks than you have, that are active across the entire United States. you get more diversification because the correlation of GDP between individual states in the United States is much lower than is the case in the euro area. And so the diversification benefits of cross-border activity are going to be commensurately lower. I think that's a fundamental, economic consideration that has to be taken into account in those kinds of decisions, and then maybe some of these other factors as well. It's a complicated issue, yeah, I mean, I think what has been said about the funding side is important as well.
Then this concludes our e-lecture on the new ECB Financial Stability Review. Thank you very much, John and Tamarah, for your excellent summary and for answering to the many discussion points from Olli and to the questions from participants. Have a good afternoon and stay safe. Bye-bye.
Thank you. Bye-bye.
Thank you.
Bye-bye.
Bye. Thank you.